want to welcome everybody to the video for assigning and factoring of receivables. We're going to cover accounts receivables and a little bit of notes receivables. Assigning receivables is when you take very specific receivables and say, okay, I want to use these receivables as collateral against the note, so that when you collect those receivables, you'll actually pay off some of the note. Okay, so what we're going to do is the company assigns $70,000 of its receivables to a finance company. The finance company is 80% of the assigned. They give you. I want to welcome everyone to the video for assigning and factoring of accounts receivables. And first we're going to do is assigning receivables, which is also called a secured borrowing. And what this is, we're using specific receivables to use as collateral against the notes payable that we're getting from the bank. Okay, so what we have here, company assigns $70,000 of its receivables to a finance company. The finance company gives you 80% of the assigned receivables minus a small $300 service charge. The finance company also charges 12% on the outstanding balance, and we'll get this collected in 2 months, so it's not that too bad. First thing we want to do is to take the receivables out of the general receivables and put them into the assigned receivables. So we have accounts receivable assigned, and that will be for the $70,000. And then what we'll want to do is take them out of the general accounts receivable and that's for also $70,000. Okay. Now for the amount of cash we're collecting. This is from the finance company. So we're putting up $70,000, and we receive 80% of it minus the $300 service fee. So we'll have equal, again, 70,000 times 0.8 minus 300. So we're going to receive $55,700. Then we have the assignment service charge, expense, and that's simply $300. And then over here will be the actual note, so notes payable. And that will be equal to the 70,000 times the 0.8 or $56,000. Okay. Now we're going to assume we collected 40,000 of the assigned receivables. So we're still doing the collection. So we're going to receive 40,000, and we want to credit the accounts receivable. Now this is the accounts receivable assigned, because that's what these specific ones were for. So you have to keep them separate from the other ones. So that's 40,000. Now we're going to actually pay part of the note off then, because that's what we collected and that's what the agreement was. So we have notes payable, and that's for the 40,000, because this is the end of the month or the next month. Interest expense, and we're going to assume it's for 1 month. So we borrowed 56,000. I'll put commas in there, times 12% and times 1/12. I'll do it that way because it's for 1 month. Okay, so over here we have equal 56,000 times 0.12 divided by 12, or $560. And then this is cash over here for $40,560. Then the next month we collected the balance of them, the receivables. So the balance is cash of 30,000, because remember we have 70,000 originally outstanding. We collected 40,000 last month, so we have 30,000 left to collect this month. And this is for the assigned, and that will be for 30,000. Now we're going to pay off the balance of the notes payable. So we have notes payable. Now we don't owe them 30,000, we owe them 16,000, which is the $56,000 minus the $40,000 that we've already paid. So the interest expense, remember the interest expense also is calculated on the unpaid balance. The unpaid balance was $16,000 times 0.12, again times 1 divided by 12, because 1/12 another month. Okay? So over here we have equal 16,000 times 0.12 divided by 12, which is $160. So cash will be for $16,160. Okay, that is assigning accounts receivables. Just set up the account, assign them, and then you go on. Okay, you collect them, you pay it. The interest expense is only, we're going to do it monthly, so the interest expense, the first one's on the $56,000, which is the outstanding balance, and a lot of people want to do it on the $40,000, but it's on the $56,000, and then the $16,000 is what the balance is left. Okay, next slide is for factoring. This is when you actually sell the receivables. Now there's two ways of doing it. You can sell the receivables with recourse and without recourse. Without recourse means that if they don't collect it, that's their problem. And because of that, they also discount it at a heftier rate than what they do if it's with recourse. So the first one is the Second Chance Company sold $90,000 of its receivables to Last Hope Finance Company without recourse. Last Hope keeps 10% of the returns paid within 30. They'll pay you back in 30 days. And Last Hope also charges 15% discount fee because it's a higher rate. Now this is actually selling of the accounts receivables. So for this, we would have cash, and what you're going to collect in is $90,000. They keep 10% of it, so we take it times 0.9 minus 90,000 times the discount rate of 15%. Okay, so over here you would have equal, basically the same thing we have over there, 90,000 times 0.9 minus 90,000 times 0.15, or $67,500. Then you have a receivable from factor. Okay, and this one is the 90,000. Got my equal sign, times 10%. I'll put that in here also. So you have 90,000 times 0.1, because that's what they keep. You'll get that back in 30 days. That's for returns and that type of thing. Okay. Then you have factoring expense. And the factoring expense is the 90,000 times 0.15, or 15%, because that's what they charge you. So equal 90,000 times 0.15, or $13,500. And then you want to get rid of the accounts receivable because you no longer own them or will collect them because you resold them. And that is for the 90,000. And this is when you notify them, say you no longer make payments here because we no longer own the accounts. Okay. Now, if you return $1,500 of merchandise, so what that would be then, you'd have on your books return liability. That sets up that allowance for returns of $1,500. And then you also have then credit to from receivable from factor, because you no longer have that coming, and that's $1,500. And then if nothing else is returned, then you would get the cash for $7,500, which is the $9,000 minus the $1,500 for the returns, and then you credit then receivable from factor for also $1,500 or $7,500. Sorry. Okay. This is without recourse. If they don't pay, that's the factor's problems. Okay. With recourse, what we have is the same as above, except a couple exceptions. They charged 9% instead of 15%, and we determined that the fair value of the obligation was $3,000. Okay, so what we have on this one then would be cash, again, of $90,000 times 0.9, because they keep that for the same reason, minus $90,000 times 0.09, because the discount rate now is, the discount rate is 9%. So we have equal 90,000 times 0.9 minus 90,000 times 0.09 for the discount rate. So you're going to receive $72,900. Then we still have the receivable from factor, just like we did from above, because you still have that coming later. And that will again be the 90,000 times 0.1 with the equal sign. So that hasn't changed anything. That's still going to be the same as it was before. 90,000 times the 10%. Okay. Then this time we have a loss from factor. Well, loss, it's loss on sale of receivables. Okay, so that will be the 90,000 times 0.09 plus the $3,000 that we have as the value. We may get that back, may not. Okay, so over here we would have equal $90,000 times 0.09 plus 3,000, or $11,100. That's our loss at this point. And then we have accounts receivable, because we're factoring, which is in essence we're selling them, and that will be for 90,000. And then we also have a recourse liability of $3,000. If the factor collects from everyone, we will debit the recourse liability for the $3,000, and we will credit recourse. No, we'll credit, sorry, the loss on sale of receivables for $3,000. So what we do is reduce our loss by $3,000. We still have the loss of $11,100, but you reduce our loss. And then you also have then cash of $9,000, because we didn't have any returns this time, and credit receivable from factor for $9,000. Okay, that's for the receivables. I'm going to have a separate one for the notes because it's going to take a little bit longer. So hopefully this helps, and I'll see you in a little bit for the receivables.